I was talking to a small group on Zoom about investments naturally, and this is a group of professionals like doctors, hoteliers, or people running businesses. But I mean, not people who were in out of the stock market or the investment market every day. And some of the questions that were asked surprised and in some ways even shocked me. I mean, people told me things like that I was investing through an SIP in an equity mutual fund, but my financial advisor now tells me that I should buy a global gold ETF instead because mutual funds are yesterday's story. Or somebody asked me, should I invest in a mutual fund or an AIF, which is an alternate investment fund. Somebody else talked about their investments being mostly through insurance products. And I realized that there's a lot of confusion in people's mind between what is the type of asset and the type of structure, because they're two different things. So what are assets or asset classes? Asset classes are things like equities, fixed income, commodities, or real estate, or within commodities things like gold. So those are asset classes. So you decide depending on your risk profile, when you need the money, what your goals are, what kind of assets you want to be in. Whereas things like an ETF, which is an exchange traded fund, or a mutual fund, or a PMS scheme, or an AIF, these are all structures. So a equity mutual fund cannot be compared directly to a gold ETF because they're two completely different asset classes. So first decide on your asset allocation. I have other videos where I talk about asset allocation. So first decide on how you want to allocate your assets, and then you decide in what structure will you invest in those assets. For example, whatever, let's say you decide 40% of your assets should be in equity. Now equity, you can buy shares on the stock market yourself, whether based on your own decisions or based on some guidance. You can buy it through a mutual fund, you can buy it through a PMS scheme, and some of the AIFs or ETFs might also be equity oriented. But that is step 2, where again, not everything within a category will be the same risk profile. So you will have to look at what exactly they're doing, what the risk profile is. The tax treatment might be different. But that's the second stage. So first you have to decide on asset allocation. Then within each asset, decide what structure you have to invest in. Don't mix up the two things. And often you will find whether formal or informal advisors may not be guiding you right, because this is called a classic agency problem in economics, that the agent's welfare or good may not be the same as yours. So always ask who benefits. Many times, they might be asking you to switch from one product to the other because they are making more commission out of it, and so on. So always, at the very least, ask that how much are you making out of this. At least for starters, that might be a good thing to do. But as far as you yourself are concerned, understand properly what is an asset or asset class and what's the structure to invest in that asset class. So I hope that helps, and tell me what more you'd like to know about this.